Again, Canada's Mortgage Minute on Wednesday, July 31st, this last day of July. Beautiful summer so far. Hopefully it's going to continue a little longer. Hey, today I thought I'd talk to you about amortizations. I get asked this a reasonable amount actually, and there still seems to be a bit of confusion out there about amortization, so let me clarify it for you. Now in Canada we have our mortgages operate with two things. One is a term, and the maximum term we can get in a Canadian mortgage is 10 years, and the other is amortization. Amortization is what allows those payments to be affordable. If we only had an amortization in a term of 10 years, so you can imagine if you had to pay back a $240,000 loan, your payments would be massive. The amortization helps you stretch it out longer. Think of it sort of like a lease. You run a term, and at the end of the term you have this balloon payment that's still carried forward, and it continues on for longer. And that's what the amortization allows you to do. Under our revised Canadian mortgage rules, what happened now a few months back, was that our amortizations went to 25 years. So if you had less than 20% down and you had to have your mortgage insured either through CMHC, Genworth, or Canada Guarantee, those are the three mortgage insurers, you could have a maximum of a 25-year amortization. Now, if you did have more than 20% down, well, you've got some additional options. You can get amortizations even up to 40 years. We got one lender who still does that. However, most of them will do a 30 to a 35 year. Now, you're going to ask me and say, hey, I've heard that longer amortizations cost me more interest. You're absolutely right. They certainly will. However, there are times that it is advantageous to take longer amortizations. And those are primarily times when you want to have better cash flow, but you're going to utilize that cash flow to leverage your overall situation for the positive. When you free up this additional cash flow, I'm not talking about using it to go on that vacation or buy that new car or, I guess, spend a lot of money in Starbucks. I mean, if you really, really must, hey, I'm not here to tell you what to do, but there are better ways that you can utilize those funds. And what some of the good ways are is there's folks who have room in their RSPs. So what they'll do is they'll free up that cash from the mortgage, dump it into their RSPs, and get a tax refund. And then that tax refund we can reapply back against our mortgage again. There is other times where they may have an additional car payment or something else that they do want to wipe out, and when that is wiped out, they dump the extra money back against their mortgage again. There may be a son or a daughter, somebody going to university for short term, and they may need to be helping them out for that. There could be another business investment or some other opportunity that they want to take advantage of, and for the short term they want to be able to have that additional cash flow. Now mind you, with most of the mortgages we offer these days, they have very generous pay down options. So even if you take a longer amortization to free up cash, you can always dump extra money against it later and essentially bring the amortization back down again. So, I mean, in the long run, you may not necessarily pay any more interest. In fact, with this strategy, you might actually pay less interest. Now, will this work for you? I don't know. I mean, the best way to assess this is to give us a shout. We're always here at the Auxilium team. We're ready to assist, like our name says, to care, aid, assist, and support. That's what we do here. We'll help you do an assessment if you've got at least 20% down to see if should you take a longer, a shorter amortization. What are some of the other options? Where else could you utilize your cash? Obviously, if you have less than 20%, you're restricted to that 25 years. And again, we'll show you how much of your money is going to principal, how much is going to interest. And part of what we offer at Auxilium is once a year, we have a sit down with you. That's right, we do a review. We get you in here and we sit down and we go over your financial situation. We see what's going on in your world. And then we can tweak things. I mean, that's really the bottom line. I mean, the reality is that once you take out a mortgage, it shouldn't be something you forget about for the 3, 5, whatever term you took. It should be something that you do revisit once in a while because it's overall part of a master financial plan. And let's face it, your home being your biggest asset and your mortgage, chances are, being your biggest liability, do require that you do check them out once in a while, and that's what we'll do for you. So hopefully that clears some things up for you regarding amortizations. Any other questions with respect to those, don't hesitate to call us. Oh, and one of the other things I do get asked is, do I have to take one of those 5 ending numbers? In other words, do I have to have my amortization 5, 10, 15, 20, 25, whatever? Can I have a 24 or a 22 or an 18? Absolutely. You can do lots of in-betweens. And again, like I said, we can look at the different payment options, compare the interest costs, compare everything, and see what the best way for you would be. So again, if you need any assistance, don't hesitate. Give us a call at the Auxilium team. Hopefully where you are, the sun is shining today, and I will see you in August, which is tomorrow.